Hi. Okay, here we are, Chapter 8. One of my favorites, because it was what I did for most of my career for over 20 years as a controller and CFO. Budgeting. Budgeting. Most of my students really like this chapter from a personal perspective as well as from professional. So, a budget is a detailed qualitative plan for acquiring and using financial and other resources. All right, so it's a planning tool. Company's budget ordinarily covers a 1 year period. My budgets, I always started my budget process somewhere in August so that I could be done with it by the end of November. So when we got to January 1st, it was already in place and we were ready to rock and roll. Budgets are used for two basic things. One is planning. Here's the net income we expect for next year. How are we going to get there? And control. Over the course of the year, you're periodically looking at budgeted versus actual numbers so that you can see whether or not you're on target for that goal you set in the planning stage. If not, you make corrections. From a control standpoint, organizations compare their budgets to actual, and that's what I did. So actually, I would sit down with project managers on a monthly basis and look at not the company's budgeted versus actual, but their projects budget versus actual. That way we kept the projects on target to make their goals, and if the projects made their goals, then the company as a whole would make its goal as well. Here's the picture of the master budget that we're going to be looking at today. Everything begins with this. How much in sales do we project? And everything flows, as you can see, from that sales budget. Master budget is based on various estimates, right? I mean, that sales number that we're starting with, that's not an actual sales number, obviously, because we're projecting for the next year. The projection is going to include what are the budgeted unit sales? What's the budgeted selling price? And third, what percentage of accounts receivable will be collected in the current and subsequent periods? This is a key point, especially for accountants. The collection side, because it's one thing to bill $1 million, it's another thing to collect $1 million. So here's our example. We have Royal Company. They're preparing budgets for the quarter, so they do quarterly budgets. Here are the budgeted sales. Now they're giving us 5 months, and you'll see as we go through why we need 5 and not just the 3 for the quarter. The selling price is going to be $10 a unit. Here are the projected sales. The individual months of April, May, and June are summed to obtain the total budgeted sales. So we've got budgeted sales of 20,000 in May, 20,000 in April, 50,000 in May, 30,000 in June. Multiplied times the $10 budgeted selling price gives us total sales of $1 million for the quarter. All sales are on account, so we're not getting paid cash for anything. And the collection pattern, again, something important, especially for accountants who are responsible for collecting cash. 70% of the sales get collected in the month of the sale. 30% gets collected in the month following the sale. So in April, we have March's 30% still waiting to be collected. So there's our end of March $30,000 that we're hoping to collect in April. April sales were 200,000, so 70% of that, we're going to get 140,000 in April. The other 60,000 we're going to get in May. We were projecting 500,000 sales for May, so 350,000 will be collected in May, and the other 150 will be collected in June. And finally, this is our total picture. So June sales are 300,000. So we're going to collect 210,000 in June. That's going to leave us 300,000 minus 210 or 90,000 to collect in July. The production budget must be adequate to meet budgeted sales plus the desired ending inventory. Every company expects to have a certain amount of inventory left at the end of the period. You don't want to start a new period with zero because you have to have something to sell. The management at Royal wants 20% of the following month's budgeted sales in units. So on March 31st, 4,000 units were on hand. So that was our ending inventory from March. That becomes the beginning inventory for April. So budgeted sales for April are 20,000, 50,000, and 30. Desired ending inventory, well, 20% of 50 is going to be 10. So we're going to expect 10,000 as ending inventory for April, 6,000 for June, and this is why we needed the July number. July sales, 25,000 units, 20% of that would leave us an ending inventory in June of 5,000 units, and that also becomes the ending quarter inventory. You'll notice they're pointing out here that the beginning inventory for the quarter is the 4,000. At Royal Company, 5 pounds of material required per unit of product. All right, so here's some details we're going to need for calculating our materials budget. Management wants materials at 10% of the following month's production. On March 31st, we're bringing 13,000 pounds of material forward, and the cost of the material is 40 cents a pound. So we bring over from the production budget the number of units that we need for the month. Now, multiplying April's 26,000 units times the 5 pounds per unit means that we need for production 130,000 pounds. For May, we need 230. For June, we need 145. Now remember, the required ending inventory for materials is 10% of the following month. So 10% of 230,000 is 23. 10% of 145,000 is 14.5. And from July, 10% of July's is going to give us 11,500. So here's the total production needed for each of the 3 months. We're then going to subtract the beginning inventory. So we have 13,000 from March. We have 23,000 from April, 14,500 from May. So the material to be purchased will be 140,000 for April, 221 for 5 for May, and 142,000 for June. And you're going to see this process of calculation repeated for different budgets. Royal pays 40 cents a pound, as it told us before. 1/2 of a month's purchases is paid for in the month of purchase. The other is paid in the following month. So obviously that goes into accounts payable. Accounts payable for March 31st is 12 grand. So now we're looking at the cash disbursements just for materials. So we bring 12,000 forward from March. We had 56,000 purchased for April. Half gets paid in April, half gets paid in May. So 28,000 and 28,000. We had 88,006 purchased for May. So half of 88,6 is 44,3. So that's 44,3 in May, 44,3 in June. And then for June's purchases were 56,800. Half of that is 28,400. The balance, 28,400, goes into accounts payable for July. All right, I will see you in part 2.